Gross domestic product, or GDP, is one way to measure broad economic activity in an individual country or around the world. In the US, GDP is calculated by summing up consumer spending, business investment, government expenditures, and net exports, which is exports minus imports. We think GDP is a useful but imperfect measure for the economy. For example, government spending always positively contributes to GDP, but we believe reality is more complex. Government spending may sometimes help the economy, but other times might not. It just depends. Additionally, imports subtract from GDP even though they can reflect healthy domestic demand. That's why we don't take headline GDP readings at face value, but rather dig into the underlying components to get a better picture of what's actually going on. Beyond understanding how GDP is calculated, investors also need to consider how the economy does and doesn't relate to the stock market. Here's the key. Stock prices move in advance of the economy. GDP reports help explain what happened in the economy in a preceding quarter. But this is old news for stocks, which focus on what is expected to impact earnings around 3 to 30 months into the future. In this way, GDP reports are backward-looking and not predictive of where stocks go next.